All right. Well, good morning, and I hope everybody's having a nice summer and July 4th. My name is Max Berger. I'm a senior wealth advisor here at Diversified in the Wilmington office, and I have the pleasure of hosting today's quarterly economic webinar with our CIO, Mike Horwath. Couple housekeeping items to go through first. As I just mentioned, this is a quarterly webinar. So this is going to be reviewing the second quarter of this year. We are also sending out a quarterly market commentary that should be out later this afternoon. And we do our weekly emails and a number of communications throughout the year, as I'm sure that you all see. The second note is we will be recording this. So we're going to have a replay out. It's typically out next week once we're done finalizing everything. But if you want to go back and watch this, if you want to share this with others who you think would be interested or appreciate that, please feel free to do so. And then lastly, there is a question and answer panel on this webinar. So if you have questions, we do have time allotted at the end for you to send questions in. We'll address what we can, and if not, we'll have your advisor follow up with you specifically. So in a moment here, I'm going to turn it over to Michael Horwath. He is our Chief Investment Officer. He's been with Diversified since 2016. He is a CFA charter holder, and he heads up our investment committee. And he's going to be talking about what happened in Q2 and what we're looking forward to with regards to the economy and our portfolios. And I think when you look at Q2, we saw a pretty remarkable recovery, which Mike is going to touch on. And I think it's the quintessential example of staying the course to the strategic asset allocation that we set when we do our financial planning, because the only way to get through these trying times and the volatility is to ride it out once we have a strategic allocation in place. So Q2 was a great example of that. And with that, I'm going to turn it over to Mike.
Awesome. Thanks, Max. Appreciate it. Welcome, everybody. This is our normal quarterly market and economic update. Every quarter we try to make it, or I try to make it, something around a certain theme or something along those lines. We're calling this one spring cleaning, so my newsletter will be around spring cleaning. It is July, it is not spring, so it probably doesn't make any sense from a title perspective, but maybe if you read it, you'll get kind of the point, and we'll talk a little bit about it here shortly as to kind of why, it's never too late to do some spring cleaning. But as Max said, my name is Mike Horwath. I'm the Chief Investment Officer here at Diversified. Been here since 2016, and many of you have seen my pretty face over the course of the last several years. Q2, and really, we go back to the beginning of the year. It's been politics, and more politics, and I really don't want to spend too much time on this space. I don't think anybody wants to hear my opinions per se on politics, but the big thing I would point out, right? It's always important to kind of take a step back, and I think anytime, regardless of what administration, what policy, I think the natural reaction is to have very heightened emotions to political decisions, and they're all rational, they all are valid. The key that we try to take away from it is, how does it impact our clients, their financial plans, the investment portfolios, and what decisions do we have to make because of that, right? And trying to take away the biases and the emotions from it, and look at it in real terms, in terms of one narrow set of markets, of portfolios, the economy, and really the financial plan is the ultimate piece to all of this. And I think, the quote on the right-hand side here is really where I like to focus and really point to, is that, look, the market isn't political. Right? The market is just solely focused on policies that increase or decrease corporate earnings or support or hinder economic growth. Right? And you can interpret one thing one way or the other, but at the end of the day, our portfolios are going to be determined by decisions that will either increase earnings, decrease earnings, or support or hinder growth. right? Those are the most important factors. When we see what's going on, our focus is how does that decision impact those two items? Because those two items are going to really be the biggest focus then at that point for how we position portfolios. Where do we see opportunity? Do we want to be more risk on, risk off? Things like that all kind of come into play when we talk about it in that context. Because when you look over the long term, you've seen these types of graphics. This is the economy. You could overlay the S&P 500 in the same graphic. It's the same story. There are always going to be blips, but over the long term, red, blue, green, purple, whatever color political side you want to be on, the trajectory has been largely the same, right? Going back over very, very long periods of time. Now, there's always blips, short term, understand that, but long term, our focus is always the same. As Max alluded to, when we kind of just dig into what happened in Q2, what's happened really year to date, I always joke with people, I'm like, look, if you went to sleep on January 1st and you woke up on June 30th, you'd look at your portfolio, and most portfolios were up. They were up mid-ish single digits in a diversified portfolio. You think it was a pretty calm, straightforward, positive year. You're not upset with that rate of return. What you're missing is nearly a bear market in the middle of all of that. You're looking at, a ton of political noise, a ton of, headline risk, whether you're listening to one news outlet or the other. Look, at the end of the day, you went to sleep Jan 1, you wake up June 30th, and your portfolio is all of a sudden up, likely mid-ish single digits. Quite a lot's happened in the middle. And a lot has changed, and not a lot has changed. And I think we need to kind of dig through that and synthesize that here today when we talk about how we're looking at it today and moving forward. So from a global stock perspective, the MSCI All Country World Index, right, that's global markets, if you will, about 10% on the year. Really strong global equity markets. The S&P, which I think a lot of domestic investors are looking at, up about 6.2 in terms of equities. And then towards the bottom, you see the Barclays Ag, U.S. fixed income. So U.S. bonds up about 4%. So U.S. bonds have had a pretty solid year as well. What's really interesting this year, and we've received more questions than probably I've ever seen in the last nearly decade, is you see international, both developed and emerging, up 15 to 19%. We've seen this reversal in leadership here on the equity side. When we look at global stocks, we've had this long run of leadership from U.S. large cap. This year, it's been international really driving it. And I think there's really three main things. And the question we get is around, should we be shifting more into international? And we'll highlight that in a second. In the end, international stocks have outperformed for probably, call it 2-3 reasons, right? One being, when all the tariff conversations happen, a lot of institutions, a lot of foreign institutional investors have been overweight US relative to international stocks. A lot of that capital, or some of that capital, had drifted out of the US to some countries, and really sovereign funds or institutional investors are rebalancing their portfolios, taking a little bit of that growth that they took from US and moving it out into international markets. Two, you've seen the US dollar depreciate this year. That's a big piece of this whole thing. US dollar, when it depreciates, foreign stocks will get a little bit of a tailwind. And it's been the complete opposite the last several years, where you've seen this really strong dollar. Well, that's supportive of owning US equity. So US dollar depreciating has been a little bit of a tailwind for foreign stocks. And also the other part of it is just foreign stocks came into the year much cheaper than US stocks. Now, part of that is for a reason, one being growth. US equities, largely from a growth perspective, have been growing the bottom line and top line much quicker than foreign, whether it be developed or emerging markets, just much quicker. So there's rationale behind that. But whenever something's a little more expensive and there's a pullback, a lot of times the more expensive asset is going to be hit relative to the cheaper asset, at least in the short term. So this year, if you're Rip Van Winkle, you probably didn't notice a whole lot. Those of you who have lived in the real world, like myself, it has been bumpy, choppy, headlines everywhere. But when you just look at the numbers, it's been an interesting, first 6 months of the year. A lot of the conversations around what happens from a GDP perspective and growth perspective, and this is what we're trying to look at moving forward. So Q1 was interesting in the sense that we saw negative GDP growth. that negative GDP growth has been revised a couple times, but Q1 really it was mostly attributed to this net imports number. So if you think about the components of economic growth, one of the components is net import. So if you import more than you export, that will hurt your growth. You export more than you import, right? That will help your growth. Well, with all the tariff conversations happening, some of the attribution comes via consumers here in the US, businesses trying to get ahead of the tariff conversation and importing more than naturally we're exporting, and that will hurt growth. Now, the good part is we believe that that's largely just a blip, and it ultimately will work its way out in the sense of inventory adjustments, consumption, all of these little things will get adjusted over the course of time. And we right now see Q2 projected, a little bit north of about 2.5% for growth. So we're not expecting 2 consecutive quarters of negative GDP growth here in the US. And it is hard to envision a recession right now, and at least anything meaningful, given the state of US fundamental economics, right? And the corporate state. So, and we'll touch on all these little things here as we move forward, but from a growth perspective, this is very important to us, and it's important on a couple of different levels. One, we do believe, and you've heard it from me before, that you have to grow the economy. If you're going to run fiscal deficits, which you've seen this big, beautiful bill, it does not even this bill, right? You go back the last couple of decades, we have consistently run fiscal deficits. We continue to do that. Well, one of the metrics for what your debt looks like is your debt to GDP. So if you're going to increase your debt, that denominator, your GDP, needs to also grow, or that is going to be a severe hindrance. So growth is going to be important, and really growth is going to be a key here. And you hear it from the current administration, where we have to grow and inflate our way out of running consistent fiscal deficits. Is the debt situation sustainable? No. It's more sustainable if you can grow along the ways, but if you don't grow, it becomes even less sustainable. So growth is an important piece here that we're really focused on. From a labor perspective, this has gotten a lot of conversation. So on the right-hand side, you can see, the darker bar is unemployment, and it's inverted, right? So as it's moved up over the course of the last couple of years, that means unemployment's dropped. And you can see where it sits as of the graphic here today. It was 4.2, and the most recent report late last week came in at 4.1% unemployment. So the June report was really strong. There were some mixed, whether it was private payrolls or government payrolls, but in the end, right, unemployment remains at 4.1, and wage growth has remained sticky, which is good, but it's not running. You'll look at the orange line, it's not running at where it was around 6, almost 7% at the height of some of these levels. And the reason why that's important is when you talk about inflation and demand, you want wage growth. When wage growth outpaces inflation, it's less of an impact. The concern is if there's too much wage growth, you can start to see way too much demand, maybe not enough supply, and then you could potentially run into an inflationary problem, right? And problems kind of in quotes, because you do have consumption going on. But at the end of the day, the labor market has been really strong, and you combine that with what you'll hear from the consumer side, it provides this really strong backdrop. When people are working, when wage growth is reasonable, the consumer can largely continue to spend. And when consumer spending is continuing to push forward, it's hard to envision a recessionary environment or anything overly too impactful from an economic growth standpoint. Kind of leading into the consumer, you've heard me say it once, twice, 4,000 times. People are probably sick of it, but consumption, we are a consumption-based economy. We are different than China, right? China being the second largest economy. Consumption is a much lower amount from their perspective, and I'd argue that they have a consumption problem relative to the US. The US is very reliant on consumer spending. 70%, maybe 68, 70% of our GDP is driven off of this number. So the health of the consumer is extremely important, right? The health of the consumer and the spending of the consumer will drive a lot of what happens from an earnings perspective naturally, but also from an economic growth perspective. So we're trying to monitor what that always looks like. So what we've seen over the course of the last really several months and several years has been pretty consistent consumer spending. Things are definitely getting a little bit tighter. So one of the things we are focused on is what is happening on a forward-looking basis. And I mentioned it here. There's been some mixed signals in the sense that you're seeing a little bit of weakening. Part of it is consumers are saving a little bit more. I think personal savings went from 4 to 5%. That type of move means you're going to be spending a little less if you're anticipating trying to build up a little bit of a safety net. But you're seeing people like the Visa CEO on earnings call say, look, people are spending, which is very, very important as we look forward from the health of the economy and obviously the equity markets and debt markets as well. But there is this disconnect of hard and soft consumer data. So I'll touch on that in a second, but if you stay on the hard data, right, the big thing being labor markets, wage growth, strong, you just heard it, you look at individual wealth. So if you look at the net worth of the average consumer, it's never been higher. So the average person, personal balance sheet, corporate balance sheets, very, very healthy, right? The government balance sheets may be a little less exciting. I think more of an issue and a concern. But if you look at corporate debt, corporate leverage, personal debt, personal, wealth in terms of total assets versus liabilities, coming from a very strong point. And it's hard to see, things may weaken, but it's hard to see anything too drastic happening to the downside, given that backdrop. Now, what do I mean though by hard versus soft data? The hard data is the numbers, right? Those are the numbers you get out, the jobs, the spending. You can look at something like a Visa CEO and their numbers and what they're seeing from a consumer spending perspective. The soft data is kind of the feelings. The soft data are things like the University of Michigan Consumer Sentiment Survey. Well, that stuff has said something a little bit different over the course of the last, for a little while here, several months, if not a year at this point, where people don't feel as good as the numbers are showing. And there's this disconnect here with people and their expectations around the economy, their expectations around inflation has really driven sentiment really down. So the consumer, at least on these survey soft data perspective, they feel bad. But then you look at the hard data, the spending, the balance sheets, the job numbers, wage growth, they all look pretty reasonable. They all look pretty good. And what it tells you is usually these things follow together. If there's a disconnect here, they're going to converge. And the question is, does the soft survey data move closer to the hard data, to the positive? Or does the hard data, does labor market, does spending start to soften, things like that? So that is one of the things we're looking at is which side is going to converge, right? And maybe they kind of converge together a little bit. We did see sentiment pick up last month, but this is something we're really focused on here as we look forward. A lot of talk about the Fed, there's no surprise. Trump wants the Fed to cut rates. The Fed, namely Jay Powell, but really other members of the Fed, Jay Powell may be the chair. He only has one vote. There are several voting members. The Fed has kept rates where they are. I think naturally the conversations around tariff. What will the impact of tariffs be from the standpoint of inflation? And I think, inflation's come in. Inflation's been a little bit more consistent. You see it here right in the mid to high twos. I think if inflation stayed in the mid to high twos, the Fed would be perfectly comfortable right around that number. The question is, what is the impact of tariffs? Over the next couple of months, we may see a little bit of a tick up in CPI just because when they measure year over year, last year in the summer, inflation was pretty moderate. So we may see a little bit of a tick up, but largely we think inflation is going to remain pretty reasonable. It may tick up a little bit because of the tariffs. I look at tariffs less about necessarily inflation, more about consumer demand. Why do I say that? So in the end, tariffs are a tax on imports. So iPhone comes in, a tariff on that product. is a cost, and the question is, does Apple eat it? Or does Apple pass that along via higher cost? And I think the natural inclination is, well, yeah, they're going to just pass that along to the consumer. So now you're going to see this inflationary environment. While that may be the case, I would tend to look at it and say it's probably more likely to hinder the demand for that product and start to look for substitutes rather than necessarily everybody just buys the same amount of that product at just at a higher cost. So I think there's some things there that we're trying to look at of what the impacts are, and we still are trying to figure out what the rules of engagement are. But if we just take a step back, CPI inflation has been steady. We're monitoring it. I think my concern is a little bit to the upside, but we're not expecting anything to spike in the short term. And I think the Fed is going to remain steadfast until they have a little bit more clarity on the impacts. But both the underlying members of the Fed and markets are pricing in rates coming down over the course of the next 6, 12, 18 months. The question is how much, how quickly. So we'll see that path, but that is the expectation as we move forward. And then naturally, anytime you're talking around what the Fed's going to do and why, I think a big part of this, and some of the conversations we've had have been around this consistent deficit that the US government continues to run. This is the federal deficit over the course of the last really, almost century, going back to 1930. You can see a whole lot of fiscal deficits. And if you grow your economy, it becomes less of a problem. If you're not growing, it can become a major problem. And here's the big part, and probably a big part of why the administration does want rates to come down, is that as rates have remained a little higher, they are paying interest on that higher rate. The higher rate ultimately is a bigger part. So if you look at the annual budget and the deficit of the US government, a huge chunk and a growing chunk of it is just interest on our debt. So if rates remain a little elevated, I think this is something to keep in mind. I think this is a reason why they need to promote growth. We need to grow out of it. And I do think promoting growth and a long-term growth mindset will be a positive, though, for equity markets. But I think this also puts a little bit of a damper on our expectations, at least owning intermediate to long-term treasuries. It's just a place that we're a little bit concerned about, given that there could be some risk to the upside that if both domestic and foreign investors require more compensation to buy US government, especially intermediate long-term debt, there could be some movement up in yields and requirement on yields in that space. So what does spring cleaning have to do with any of this? The way I look at this is, in the end, I think Q1 and Q2 have taught us again, or reminded us, that we have to keep this long-term perspective. And part of keeping that long-term perspective is to do a consistent checklist of reminders, and it's almost a mental and emotional checkup, if you will. And I'll talk a little bit about what that should look like. But for perspective, the S&P and what happened in Q1/Q2 was the quickest recovery ever from a 15% drop in markets. And we've seen this consistently over the course of the last, call it, decade, right? 2008 was really the last time that people saw markets drop and take a while to recover. You think 2020, coming out of 2022, and this year, we saw a 15% drop. Well, we saw really 19-ish% drop in the S&P 500 from February 19th to April 8th. We saw that drop of 19%. And within 55 trading days, all those losses were recouped. That's what makes emotional decisions and abandoning a long-term strategy so difficult. That if you were to sit there on April 8th and say, I wish I sold, I need to get out now, and not think about the long-term expectations, you'll lose a lot of that recovery. You would have sat here today extremely frustrated with that decision. So by doing what I would call my spring cleaning honey-do list, we all love those, from a financial perspective and financial planning perspective, you're spring cleaning every year. Don't care, it doesn't have to be in the spring, but should be a checklist of let's go meet with someone like Max and his team and all of our other advisors here at Diversified. Reforecast the financial plan, because a lot of the decisions that are made at times of stress are made of thinking that a lot of these components have now broken. My financial plan is now broken. My portfolio is now broken. And the reality is, when we build these things out, we're doing it from the mindset of knowing that this is likely to happen. The longer you hold your stocks, the more likely it is that you're going to live and see more and more of these time periods. So from my perspective, the honeydew list should be to reforecast, stress test, run scenarios on that financial plan, reevaluate the risk you're taking in your portfolio. What do we need to take? That first check mark should be, what does my, really the first two are all around, like, what is my ability to take risk in my portfolio? What do I need to do? And then, look at my positioning today. What's the expected long-term return? Do I have my return set so long-term I'm going to hopefully meet what that financial plan needs to hit there? And then naturally you can bring in ancillary planning items. But to me, all this checklist and the honeydew list of revisiting your financial situation and coming in and sitting down with us, as always, is to kind of check the mindset of, when time periods happen, like Q1, Q2, that we've already planned for it. We know what's going to happen. Sure, everybody would want to sell on February 19th or February 19th was correct, and then buy back in on April 8th. It's just not practical, and it's not really the right decision to make. So how do we maintain our mindset over a long period of time? I think it's consistently following this spring cleaning. Every year you're doing certain things in the spring, preparing for the summer. I suggest consistently doing that. And it's something that certainly we promote, and many of you already do. How are we thinking about this in the context of our portfolios? I think one of the questions we get is, should we own more international? Do we need to change how we're thinking about this? And the funny part is, as we've sat here and looked at what's happening in markets and how we want to position ourselves, we haven't really wanted to make drastic changes. We don't think a whole lot has actually changed. And why is that? Look, we've had this tilt into US large cap with kind of this focus on a little bit more high quality, meaning, one, the S&P 500 has made itself into a higher quality index. If you look at the debt levels, dividends, the types of quality factors you would look for. But then also have like this quality dividend tilt. Why is that? Well, if you look at the long term, especially the last 5-10 years, it really comes down to earnings. We still see US large cap as a space of the highest quality, consistent earnings. You can see on the right-hand side what's happened. It's not a surprise that equity markets have driven up the way they have, especially here domestically. It's just followed earnings. And we do expect earnings to consistently grow here looking forward. The question is, to what extent? And the markets are pricing in consistent growth. So that is key, right? Earnings will have to continue growing after we've recovered all these losses from that short window there, Q1 into Q2. Our expectation for international, we still are sticking with that 15 to 20% recommendation, right? For the most part, unless there's a drastic rationale to change that perspective, our expectation is we want to own about 15 to 20. That gives you the diversification benefit. I think us owning international in Q1 and Q2, really the first half of the year, has been beneficial. We've been happy we've had this weighting. We're very convicted in some of the names we own internationally. We tend to be a little bit more active, but we're not gonna lean heavier into it. We still see the domestic markets, especially domestic large cap, as a better place to put our clients' stock capital. Doesn't mean we don't want to own it. It doesn't mean that it can't continue to perform well, especially if the dollar does continue to weaken a little bit. But we're not leaning heavier into it. On the fixed income side, I mentioned it earlier. I think we are consistently going to own treasuries as part of the fixed income portfolio, but I would say that we are pretty decently underweight treasuries. Part of it is our concerns over fiscal conditions here in the US. We don't want to lean too heavy into it. We own it, though, from the perspective of it's probably the best diversifier from an equity to stock or equity to bond perspective when markets fall. So it's kind of this I don't say insurance policy, because it's not, but it's that real diversifier where we are leaning into shorter duration corporate credit, right? Corporate bonds. Why is that? we just look at what happened over the last 5 years. Corporate fundamentals remain really strong. You look at debt, you look at earnings, you look at all those ratios from a coverage perspective. Corporate fundamentals are really strong. We just prefer to be a little bit short duration, a little shorter on the curve, and leaning into corporate credit. We are looking at tips. I will say that we are looking at tips to potentially replace kind of our nominal treasury, because we look at it and say we can get some of that diversification benefit while still kind of protecting the bond portfolio from an inflationary spike if it were to come. Not our base case, but we ask ourselves what could go wrong and what are the expectations moving forward. But from a portfolio perspective, it still remains a focus on earnings and inflation. Earnings, especially on the equity side, we are going to follow the earnings and our outlook on earnings. And then inflation, especially on the bond side, I think we want to make sure we insulate, and address the inflation conversation with regards to bonds, because you see what can happen in 22. That was a far left tail example of what could happen, but we're just trying to make sure we're diversified well in that space. I always like to highlight a couple things though, just to wrap things up on what's working in portfolios. You can see on the year on the right-hand side what happened, right? I think this has been one of the biggest conversations. Has been, the S&P is the green line, the ex-US, so really foreign stocks being the gray line. You can see coming in, like the foreign stocks held up well from February 19th through the end of the quarter, right? So from that drop, you saw it really come down, and then you saw both foreign and domestic stocks recover. Everything foreign stocks have picked up about 10% from that peak at that point, and you see the full recovery even in the S&P 500. But us owning international, whether you're owning active, passive, year to date, you're up most likely double digits for that asset allocation. So when you have domestic equities up mid-single digits, that diversification benefit has certainly been helpful here for the first half of the year. Many of you know we've owned semiconductor ETFs over the course of the last really several years. That theme has continued to play out this year. Through the first half of the year was up a little over 15%. So it's been a really good story for us. We've been really happy for it. And then owning short duration credit has also been really helpful, right? One of the strategies we use, the JP Morgan Income ETF, is up over 8% over the last year versus something like core bonds up, which is treasuries, corps, and mortgage-backed securities, or right, the securitized part of the market. That's up about 6%. So you're getting a little bit of benefit over last year for owning shorter duration credit. Still a space we like, but overall we've had a lot of pieces of the portfolio that we've been happy with beyond just the normal US large cap, which has been the primary theme over the course of the last several years. So we've seen diversification really help kind of enhance portfolio returns above that. So spoken probably a little longer than I should have, but hey, with the last 5-10 minutes, Max, I'll kind of bring you back in. Any Q&A, anything worthwhile kind of digging into?
Yep. So it looks like we got time for a couple questions here, but first off, great job, great content. This is very helpful as always from you and your team. And I think you hit on a couple really important things. Number one is the disconnect between sentiment, headlines, and fundamentals. And it's a reminder that the news outlets and what we see out there is not necessarily the story. And we need to continue to fight through the noise and focus on data and things that are moving markets. And the second really important thing that I think you hit on at the end there with regards to the spring cleaning was, hey, it's easy to talk about the portfolio when it's doing well. And there's also questions about what's happening in times like earlier this year when the tariffs are impacting your portfolio. But it's always a good time to reforecast the financial plan and make sure that your allocation and your saving strategy is in line to your goals. So I think that's great reminders as always. The first question we have is regarding valuations and where we're at in the markets today. Given where valuations are, is there a time where Wall Street and analysts are saying we should be taking something off of the table, right? should we take some of these profits with prices being elevated, or is the thought that they can continue to run?
Yeah, I think there's a couple different ways to think about that. It's a great question. It's something, one, we look at when making determinations of how we want to allocate portfolios and capital for our clients is, look, if something is extremely expensive or extremely cheap, why? I mean, I think that's the first question you should ask is why, and dig into that. But naturally, you don't want to own the most expensive stuff. You don't necessarily want to, avoid the cheapest stuff. You want to make sure you're balancing that conversation. I think it's been something we've talked about for the last really couple of years is you see the forward-looking valuation on let's just use the S&P because that's the easiest one to talk through. Low 20s multiple of either last 12 months or the next 12 months earnings. Historically, that number is closer to 17% forward earnings. And then the question is like, hey, Mike, like that's kind of pricey. Should we be running? And I think there's a couple of nuanced discussions that we're having. One, it is pricey, and here's why. So if you dig into the why, it's really two things. It's expectations around growth. So if you look at growth from an earnings standpoint on the S&P over the course of the next 2-3 years, expectations are priced in around 10-ish% earnings growth in each of these years. When you start to do that math and you start to say, okay, in 2 or 3 years, when I get to that point, what does that valuation look like? You start to, okay, I get why it's being priced in the way it is. Now, what that means is earnings have to meet that. So if earnings aren't meeting those high thresholds, I think that's when it becomes naturally a concern, and maybe that is not warranting that level of valuation. Two, I think it's the index is different today than it was 40 years ago. And I get a little concerned when we use 17 times or 18 times forward earnings or earnings to say that has to be the valuation measure, because even looking underneath the hood, every sector itself has historical different valuation metrics. Typically financials, energy, staples, slower growth, bigger dividends, more mature businesses and sectors, they tend to trade at lower multiples. Tech, some discretionary companies, higher growth companies tend to trade at higher multiples, right? Because you're pricing in that future growth. Well, what's happened to the index is that the S&P 500 has become a little bit of a growthier, higher quality index. And I think the valuation measures on it have also correspondingly moved up. Doesn't mean it's cheap, because it's not. One of the arguments for international has been this, hey, it's cheaper. Well, we come back to, well, it's cheaper for a reason. And if you look at some of the biggest names in the S&P 500 versus international, right? And it's, whether it's like Siemens or SAP, you think about these really, high quality European names versus use the Mag 7. They're trading at similar multiples, but you look at the growth numbers underneath the hood, the Mag 7 numbers have driven such incredible growth year over year, where you start to see why those valuation measures are the way they are. So I'm not running from current valuations. I'm monitoring earnings to see, hey, if those expectations that are starting to wane, maybe it does make sense where we start to think it's a little bit too expensive. But that conversation is certainly part of our decision-making process of asset allocation, where we're tilting portfolios, what we like, don't like, where we're willing to go a little heavier into, right? But you think about markets right now, the reason why international, and look at small cap as well, is they're both trading at 30% discounts to the S&P 500. Well, big part of that is, there's a reason. Like the earnings have been woeful relative to US large cap, and maybe that is warranted. That's a great question.
Yeah. And it looks like we got one more here that we're going to touch on. What are our overall thoughts on the energy sector? There's, of course, been a lot of changes, especially with regards to the latest spending bill. What are our thoughts on the energy sector looking forward?
Yeah, I think, I think we kind of can get down to more names and stuff like that. I think it's a nuanced question in the sense of, I think as a sector, we're pretty neutral to probably less than excited to lean into it. So I'd say, if anything, we are not leaning heavily into energy. You look at Trump, 1.0 his first term. He's been I think intuition is supportive and deregulation to that energy sector, at least traditional energy. But if you look at the energy sector performance in the first term, it was, even if you excluded the COVID period, it was flat to negative. You look at moving forward, I think we're in the same boat where I think there's so much movement and obviously the Middle East and what's going on there. There's going to be a lot of movement in terms of energy prices, oil prices, and how that ultimately affects, because those prices will drive a lot of what happens in traditional energy. Now, what I will say is one of the areas that we do like and think about are things like energy infrastructure names that, if you try to play and think through and play out the growth of AI, the growth of technology, the growth of a lot of these server farms and data centers, is you are going to need energy. And how do you lean into that space and trying to find areas of energy infrastructure, or names like Constellation have really run given the nuclear backdrop of a company like that. But there are plenty of names that can be more along the line of the infrastructure conversation and trying to identify businesses and sectors and industries that are leaning more into that rather than the traditional exploration and those types of names that many people know. So I'm a little bit less bullish on those names. More bullish on kind of the infrastructure and trying to play that out over the course of a longer period of time.
That's great. Wonderful. Well, I think we're at time for today. Mike and team, thank you again. This is great as always, and everybody who attended, we super appreciate it. I hope you guys enjoy your summers, take some downtime, and just know that we're always here for you, and we super appreciate everybody. So thank you again, and I hope everybody has a great rest of their day.